Welcome back to the Deep Dive. Today, we're really getting into the architecture of financial success.
That's right. We're looking at the frameworks, the mental models used by some of the world's most successful people.
People who built incredible wealth, but maybe not in the way you'd expect. We're focusing on a philosophy that kind of flips the script on risk. It's called the Dhandho philosophy.
Exactly. Dhandho. It's this core idea about building businesses, making money, but without taking on huge amounts of risk.
Yeah.
Or ideally, almost no risk at all.
The classic line sums it up right.
Heads I win, tails I don't lose much. That's the essence. If it works, you win big. If it doesn't, well, you haven't lost your shirt.
And we're talking about people like Bill Gates, Sam Walton, Richard Branson. Our sources suggest they weren't just lucky. They used these kinds of principles.
Absolutely. They followed a formula, whether they called it Dhandho or not. It's about structurally minimizing the downside.
So our mission for you today is to give you a shortcut, really.
Yeah.
A way to grasp these powerful mental models that, challenge that conventional wisdom that says you have to risk big to win big.
If you've ever thought about starting something, but the perceived risk held you back, this is for you. We're providing a blueprint.
Let's dive in.
Okay, so let's define Dhandho properly first. It's a Gujarati word. From Gujarat in India, the same region Gandhi came from, actually, known for producing really astute business minds for generations.
And it means business, but it's more than just that, isn't it?
Yeah, culturally, it implies a way of doing business, a method where you're constantly focused on mitigating risk, pushing it down towards zero. Not necessarily zero risk in a philosophical sense, maybe, but definitely minimizing the capital risks.
Right, the financial downside.
Yeah.
Which forces us to look at something we all kind of accept as normal, the supposed safety of the 9-to-5 job.
Oh, absolutely.
Yeah.
Society tells us, get the steady paycheck, that's the safe route, low risk.
But the sources we looked at argue the exact opposite. They say the 9-to-5 is actually the really risky path.
It's the ultimate risk of omission, isn't it? You get one life, and that job, well, it often consumes the time, the energy, the mental space you need to pursue what truly matters to you, what some sources call getting your music out.
Finding your purpose, building something meaningful.
Exactly. So the entrepreneur using Dhandho principles minimizes financial risk, sure, but the employee in the safe job, they risk losing the chance to fulfill their potential to get that music out. That's a huge risk.
It flips the script. People think entrepreneurship means, second mortgages, maxed out credit cards, huge personal guarantees.
And sometimes it does, but that's often because people don't understand or apply these Dhandho ideas. If you realized you could start something with very little or even zero financial risk, well, a lot more people might take the leap.
And there's a fantastic real-world example of this in action, the Patel Motel story.
Ah, yes, it's a classic case study. It really illustrates the power of this approach. It starts with the Patels, an ethnic group from Gujarat, India.
Many had settled in East Africa, right? Uganda specifically.
Correct. Over generations, they built successful businesses there, trading, commerce. But then in the 1970s, Idi Amin expelled them, forced them out basically overnight, leaving almost everything behind.
So they arrived in places like the US, UK, Canada, often as refugees. They had business smarts, tons of it, but maybe not the specific degrees or, the language fluency for immediate white-collar jobs in the West.
Exactly. They needed an entry point, and they found one. They identified these small independent motels, 10, 20 rooms, maybe family-run places as a potential vehicle.
So how do they apply Dhandho? How do they make that low risk?
It wasn't about some complex financial engineering. It was about radical cost elimination. Think about running a small motel traditionally. You need staff.
Sure. A manager, cleaners, someone at the front desk.
Right. Payroll, workers' comp insurance. These are significant fixed costs.
Mm-hmm.
The Patel families did something genius. They eliminated almost 100% of that labor costs.
Yeah.
The family became the staff. They'd buy a motel, maybe with some tooled resources or financing, but the key was the operating model. The family would move into 1 or 2 rooms right there in the motel.
Living on site?
Living on site. And the entire family unit, husband, wife, kids, sometimes extended family, they did all the work, cleaning the rooms, managing the front desk, doing the laundry, basic maintenance. They were the labor force.
Okay, I see. So the payroll cost just vanishes.
Completely. Or rather, it gets replaced by the family's living expenses, which they'd have anyway. Think about the competitive advantage that creates. Down the street, maybe there's another motel charging, say, $25 a night.
And they have to charge that because they've got maybe a 30% payroll burden, right? They have staff salaries to cover.
Precisely. Their costs are higher, fixed. But the Patel Motel, having eliminated that major cost center, could operate profitably at a much lower price point. Maybe they charge $19 a night.
Undercutting everyone.
Significantly. And what happens when you're the cheapest option, often by a wide margin?
Your occupancy goes way up. You're full when others aren't.
Exactly. They might run at 90% occupancy or higher, even in the off seasons. So they're generating more cash flow, paradoxically, from a lower price point because their volume is so high and their operating costs are so low. Heads, I win.
Tails, I don't lose much because the major cost variable, labor, is essentially zero.
Perfect. And that cash flow wasn't frittered away. It was plowed back into the system. They'd save diligently, then buy the next motel.
And replicate the model.
Send a nephew, a cousin, another family member to run it using the exact same zero labor, low price, high occupancy strategy. It became a repeatable, low risk engine for acquiring assets.
And the scale of this is just incredible when you look at it today.
It's staggering. Patels make up less than 0.1% of the U.S. population, but estimates suggest they own something like 80% of the motels in the U.S. Not the big chains necessarily, but the independent properties.
That kind of dominance isn't an accident. It's a direct result of applying this Dhandho principle relentlessly over decades. Low risk, high reward, systematically executed. Okay, so once you've got that Dhandho mindset about risk, about minimizing the downside, the next layer is strategy. And the first mental model here really pushes back against that Silicon Valley narrative of constant disruption. It's the power of cloning.
Right. We're always told, invent something new, disrupt everything. But these sources argue that's often a fool's errand, or at least not the only path.
Why clone?
Because the market and just human nature really easily accepts multiple versions of the same thing. Think about coffee shops or burger joints or software. Does the world only need one? No. Cloning gives you a massive head start, maybe 90%, 95%, because you're leveraging a proven model.
Proven demand, proven monetization.
Exactly. Someone else has already done the hard work of proving the concept. You're just executing on it, maybe better, maybe in a slightly different niche.
But hold on. When we say cloning, are we talking about just, ripping people off?
Yeah.
Copying intellectual property? Where's the line?
That's a really important distinction. We're not advocating for IP theft or trademark infringement. It's about cloning the business model, the concept, the value proposition, and then optimizing or adapting it. Think about Bill Gates.
Microsoft, yeah.
He was a master cloner. Word wasn't the first word processor. WordPerfect was dominant. Excel wasn't the first spreadsheet. Lotus 123 was the king. Bing wasn't the first search engine.
So he took existing ideas.
He waited until others had paved the way, proven the market existed. Then Microsoft came in and executed often better with superior integration into their operating system, better distribution, more scale. It's cloning plus optimization.
And Sam Walton, founder of Walmart, was apparently very open about this.
Oh, famously so. He reportedly said he never had an original idea in his life. Walmart's initial success was built by meticulously studying and cloning the models of Sears and Kmart, both of which are now essentially gone.
But Walton's cloning was intense, right? It wasn't just copying the big picture.
No, he was obsessed with details. He'd visit competitor stores constantly, even stores he thought were run terribly, what he called useless operators. Why? Because he believed you could find one good idea anywhere.
Like the candle display anecdote.
Exactly. He supposedly saw a competitor with a generally awful store layout, but they had one fantastic high-margin candle display. He immediately took that specific idea and implemented it across Walmart. He cloned tactics, not just strategy.
And this isn't just for retail or software. Starbucks.
Classic example. Howard Schultz saw the vibrant cafe culture in Italy. The quality espresso, the atmosphere, the idea of the cafe as a third place between home and work.
That didn't really exist in the U.S. at scale back then.
Right. It was an offering gap. He essentially cloned that Italian cafe experience, adapted it for American tastes and speed, scaled it up massively, and the rest is history. Cloning here means identifying a successful concept elsewhere and transplanting it, executing it well.
Okay, so cloning is powerful. What's the next mental model?
This one's crucial for motivation and longevity. Purpose over profit.
Meaning?
Meaning the absolute worst reason to start a company is just to make money. That sounds counterintuitive, maybe?
Little, yeah. Isn't that the point of business?
It's a result of successful business, but it shouldn't be the primary driver. The sources argue that the true sustainable purpose has to be something deeper. Delivering an amazing product, providing an incredible service, solving a real problem for people, making a contribution.
Getting your music out again.
Precisely. If you achieve that, if you genuinely serve humanity or solve a customer's pain point effectively, the money becomes an almost inevitable side effect. But that deeper purpose is what carries you through the tough times, the inevitable setbacks. Profit alone is a weak motivator when things get hard.
Which connects to the next idea. Finding offering gaps, especially in what might seem like boring businesses.
Yeah, the media loves the sexy tech startups, the venture-backed unicorns, but that's less than 0.1% of all new businesses. The real opportunity, often lower risk and highly profitable, lies in the everyday, non-VC-backed stuff. Laundromats, plumbing, restaurants, local services.
Things people need. And an offering gap is?
Simply something that should exist in a particular place or for a particular group, but doesn't. A basic need isn't being met.
Okay, give me an example.
Let's take the barber example from the sources. Imagine a successful barber in town A. He notices a new housing development going up fast, creating a whole new community. Let's call it town C.
Lots of new houses, new families.
But no barbershop yet. It's an offering gap. Now, the Dhandho approach isn't to immediately borrow $100,000, build a fancy salon, and hope people show up.
No, what then?
He finds a small, cheap space to rent, maybe even subleases part of another shop initially. He gets some used, functional equipment chairs, clippers, doesn't need to be brand new. And maybe he only commits to working there 1 day a week to start, say Wednesdays.
Minimizing the upfront cost and time commitment. Low risk.
Exactly. Now, think about the customers in Town C. Before this barber arrived, what did they have to do for a haircut?
Drive to town A or maybe town B. Takes time. Hassle.
Right. Maybe a 30-minute round trip? Their time has value opportunity cost. So this local barber, even working just 1 day a week, is incredibly convenient.
So he can charge more.
Definitely. If he charges $30 back in competitive Town A, maybe in Town C, where he's the only option and saving people significant time, he can charge $45. People will happily pay for the convenience.
Geographical arbitrage, basically.
Perfect term for it. He's got minimal overhead, maybe just that 1 day's rent and the cost of his time. Demand is captive and immediate. The returns start flowing from day one. Zero real risk.
And then he scales it carefully.
Once that Wednesday is fully booked, maybe he adds Tuesdays, then Thursdays. Eventually, he might be there full time. By the time competitors inevitably arrive and maybe push the price back down towards $30, he's already established himself, built a clientele, and effectively doubled his business footprint, all without taking a big gamble up front. That's Dhando in action. Spot the gap, minimize the entry risk, execute simply, and scale organically. Okay, so you've got the idea, you see the offering gap, you have a low-risk Dhandho plan, but you probably still have that day job. How do you manage the transition?
Right. You can't just flip a switch usually. You need that income stream, or at least for a while. The advice here is pretty direct. Don't shut off the cash flow. Let some other yo-yo pay the rent, as one source puts it.
Keep the day job, but manage your energy ruthlessly.
This is where the strategy of performing just above firing level comes in. And I have to say, I actually did this myself for about 9 months during my own transition.
Oh, really? How did that work?
Well, you basically figure out the absolute minimum requirements of your job description. What do you have to deliver to not get fired? And you do exactly that and nothing more.
Conserving energy.
Totally. My bosses were definitely confused. They knew my performance had dipped from previous levels, but I was still ticking the boxes, meeting the formal requirements. They couldn't technically justify letting me go, even though they sensed I wasn't fully engaged.
That confusion is exactly what you want. You're diverting all that saved mental and physical energy into your own venture, the thing that actually matters to you.
Which requires serious time allocation. This brings us to the Lego blocks analogy.
Yeah, it's a great visualization. You have 168 hours in a week. Let's say 56 go to sleep, 40 go to the day job you're doing minimally.
That leaves 72 hours. A big chunk of that is what the sources call the orange blocks.
Your free time. But often it's unstructured, maybe not super productive free time, Netflix, scrolling social media, just kind of hanging out. Maybe 4 hours on a weekday evening, 8 hours or so each weekend day.
Something like that. The Dhandho entrepreneur makes a conscious decision to take those orange blocks
and turn them into yellow blocks, dedicated, focused work on the startup.
So the commitment might look like 4 focused hours every single weekday evening after the day job, and maybe 10 focused hours each day on Saturday and Sunday.
That adds up fast. That's 20 hours during the week, plus 20 on the weekend. That's 40 hours a week dedicated to your venture, while still having the safety net of the day job.
It's like having a second full-time job, commitment-wise, which leads to the litmus test.
Ah, yes! The yellow blocks must be more exciting than the orange blocks.
If working on your business idea, talking to potential customers, building your prototype, if that doesn't feel more compelling, more engaging, more exciting than watching Netflix or scrolling Instagram,
Then don't do it, seriously. That passion, that intrinsic drive for the yellow block work has to be your fuel. If it feels like a chore compared to your leisure time, it's probably not the right venture. You're not ready.
okay, so you've carved out the time, you've got the energy. Now, execution.
Mm.
The key here seems to be rapid prototyping and, crucially, listening.
Absolutely. Any idea that lives only in your head, conceived in an ivory tower between your ears, is almost certainly wrong in some important way.
You have to expose it to reality, show it to actual humans, get feedback fast.
I remember you had a story about this, right, with a bank client early on.
Oh, yeah. Painful lesson, but valuable.
Yeah.
I'd spent weeks creating this 20-slide masterpiece PowerPoint deck. It covered 7 different IT services we could offer this major bank's head of IT. I had the whole ecosystem mapped out, the grand strategy.
Ready to impress.
Totally. I start presenting, going through slide 1, slide 2. He's polite but quiet. I get to slide 10. Now, slide 10 happened to detail a very specific, very niche, but extremely painful problem that, by sheer luck, he was dealing with right at that moment. A massive headache no one else seemed to be solving.
Yeah.
He just stopped me.
Yeah.
Cold. Put his hand up. Said, go back to slide 10. Just stay on slide 10. He looked me right in the eye and said, I have zero interest in slides 1 through 9. I have zero interest in slides 11 through 20. If you can actually solve that problem on slide 10 for me, we have a deal. Forget everything else.
So you had to pivot instantly.
On the spot. Scrap 95% of my brilliant plan and focus entirely on the one thing the customer was screaming they needed. They will literally tell you what business you should be in, what product you need to build, if you just listen intensely. You need like a 10x radar for listening, filtering the signal from the noise.
That ability to listen and adapt is everything. Look at Google Glass versus the Meta Ray-Ban smart glasses.
Right. Similar tech, arguably.
But Google Glass initially kind of ignored the human element, the social awkwardness, the privacy concerns. It felt invasive. Meta Ray-Ban seemed to listen more to those concerns, making the product look almost exactly like normal glasses, addressing that human factor. Listening made the difference in acceptance.
Okay, so listen, adapt. But you also need resilience, especially when you're starting out, trying to get those first customers. The sales process example is intense.
Yeah, the physical letter strategy. It's old school but effective if done right. The source detailed sending 200 highly customized physical letters every single week.
To senior IT executives.
Yeah.
And the customization was key, right? The Dear Dave hack.
Exactly. Instead of the formal Dear Mr. David Smith, which a gatekeeper or secretary might screen out, they use the informal Dear Dave. The psychology is that the gatekeeper thinks, oh, maybe this is from a friend, I better put it on his desk. It increases the chance it actually gets seen by the decision maker.
Clever. And then the follow-up.
1 week after mailing 200 letters, they'd make 200 phone calls. Relentless follow-up. This created a structured sales funnel.
And obsessive tracking.
Absolutely critical. They had a math guy, as they called him, tracking everything. Letter sent, positive replies, meeting scheduled, deals closed. Every Dave Smith stayed in that funnel, getting follow-up calls at increasing intervals, 2 weeks, 4 weeks, 8 weeks, until they either bought or explicitly said, stop contacting me.
That requires serious discipline and resilience. Most people would give up after a few rejections.
That's the law of averages in action. You have to take enough swings. It's like the job seeker example. Sending 6 emails and getting discouraged is missing the point. The daughter trying to get into a hedge fund sent 1,200 physical letters. You play the numbers game until the averages work for you. Resilience is just math applied consistently.
And all this, ideally, ties back to the zero capital strategy. Dhandho assumes you use brain power, not necessarily cash.
Right. You mentioned you needed about $100 K seed capital, credit lines, 401k.
Yeah, which felt risky at the time, though I was cash flow positive in 9 months, thankfully. But that's small potatoes compared to the masters.
Like Sir Richard Branson launching Virgin Atlantic, that's the ultimate Dhandho case study for zero capital, zero risk in a huge capital-intensive industry.
Starting an airline in the 80s.
Right.
Needed a jumbo jet, right? $150 million plane.
And Branson had basically zero capital for it, but he didn't let that stop him. He used creative thinking and sheer persistence. He called Boeing relentlessly.
Until he agreed to lease him a plane.
Yes, a 747 that was just sitting around, apparently, on very flexible terms. He negotiated his way into having the asset without the upfront capital cost.
But how was it zero risk? Leasing still costs money, fuel, staff.
But think about airline cash flow timing. When do airlines get paid?
When people buy tickets, often months in advance.
Exactly. They collect the cash up front, but when do they pay their biggest operating costs? The fuel, the landing fees, the lease payments on the plane.
After the flight happens.
Right. So there's a built-in temporal arbitrage. Branson could use the passenger ticket money collected in advance to cover the operating costs that were due later. He leveraged the industry's cash cycle. If you can launch an airline needing a $150 menjet with essentially zero capital down by thinking creatively about cash flow, you can apply that kind of thinking to almost any business. Brains over bucks.
Okay, so you've launched, maybe you're getting traction using these low-risk principles.
Yeah.
But to grow, you need people. And scaling with people is often where things go wrong. The Dhando mindset has a clear principle here: A players only.
This is non-negotiable for the best founders. Recruiting isn't just an HR task, it's the most important job. Think about Elon Musk reportedly interviewing the first 3,000 people at SpaceX himself.
Wow, why such dedication?
Because of the core principle. A players only want to work with other A players. They are motivated by excellence, by being around other highly competent, driven people.
And the danger is hiring a B player.
Huge danger. The moment you hire a B player, what happens? That B player may be lacking confidence or true competence themselves. They won't hire A players below them. They feel threatened by A players, so they hire other B players or even C players.
And suddenly you're on a downhill slide to mediocrity.
Instantly. It's a cascade. It starts with that first compromise, that first B player hire. That's why the focus has to be relentless on A players only.
So how do you identify them? Interviews can be misleading. People rehearse.
True. Interviews are partly theater. You need to look deeper. The sources emphasize that core traits are often hard-coded pretty early in life. This is where objective tools can help, like personality or cognitive assessments, Caliper was mentioned. They provide data beyond the interview polish.
And there are specific non-negotiable traits you look for in every hire.
3 absolutes, according to these founders: intelligence, integrity, and a willingness to work hard.
Let's break those down. Intelligence isn't just IQ.
No, it's more about the ability to learn quickly, process new information, and apply it effectively in the role. Adaptability.
Integrity.
Absolute honesty. High ethical standards. Non-negotiable. Because if someone lacks integrity, their intelligence just makes them better at deceiving you or cutting corners. It's dangerous.
And willingness to work hard.
Pretty self-explanatory. The drive, the energy, the commitment to put in the effort needed, especially in a startup environment, moving those yellow blocks. If a candidate is missing any one of those 3,
terminate the interview.
Immediately. Don't waste time. You can't compromise on the fundamentals.
Okay, so you build the A team. Now, shifting to investment discipline, whether it's investing profits back into the business or managing personal finances, the principle is fewer, bigger, infrequent bets.
Right. This comes straight from investment legends like Warren Buffett. His famous analogy is the punch card.
The 20-slot punch card.
Exactly. Imagine you get a punch card when you start investing, and it only has 20 slots. Each time you make an investment decision, buy or sell, you have to punch a hole. You only get 20 punches for your entire investing lifetime.
That would force you to be incredibly careful about each decision.
Extremely thoughtful, highly selective. You wouldn't be making dozens of trades a year. You do deep research, wait patiently for the perfect pitch, and then when you swing, you'd swing big. It counters that urge for constant action, for scattershot trading.
And this matters because most stocks aren't winners.
Market reality is brutal. Research consistently shows that a tiny fraction of stocks drives almost all the returns. Something like 4% of listed companies generate maybe 90% of the long-term market gains.
So the other 96% is basically noise.
Largely, yes. Or mediocre performers. If you're constantly churning your portfolio, chasing headlines, you're likely just playing in the noise and missing the few big winners that actually build wealth.
Which leads to the idea of circling the wagons.
Yeah, it's a great visual. Comes from the old pioneer days, right? When under attack, they'd circle the wagons to protect the most valuable things inside the people, the supplies, the crown jewels.
So in investing,
your crown jewels are those few massive winners you hopefully find over your lifetime. The multi-baggers, the investments that go up 10 times, 50 times, 100 times, or more.
And the key is not just finding them, but holding on to them.
That's the hardest part. The discipline of never selling those big winners, even when they look expensive, even when the market gets choppy. The biggest mistake, the most costly error in investing isn't usually buying the wrong thing. It's the mistake of omission. Selling a truly great company way too early.
You mentioned you had a personal painful example of this.
Oh, yes. Still stings. I owned Fiat Chrysler Automobiles FCA quite a few years back. It had done really well, appreciated a lot.
So you sold it. Took profits. Seems smart.
Exactly. I thought I was being prudent, locking in gains around 2017, 2018, but I made a critical error. I forgot or didn't fully appreciate a key structural element. Inside FCA, buried in its value, was about 80% of the ownership of Ferrari.
Ah. And Ferrari as a standalone luxury
It
brand.
was incredibly valuable and was later spun off. If I had just held on, if I had understood the underlying asset value and circled the wagons around that position instead of impatiently taking profits, well, let's just say the opportunity cost was enormous.
Oh, enormous.
Based on how Ferrari has performed since. Probably about $1 billion more enormous today.
Wow. $1 billion mistake of omission.
It's a stark lesson. Patience and conviction in your true winners are paramount. That requires a certain mindset, a certain philosophy about how you interact with the world, which brings us to the givers versus takers model.
Right. This categorizes people into 3 types.
Givers, takers, and matchers. It applies to business, investing, life in general.
Takers are
Purely self-interested, always trying to get more than they give, sometimes manipulating or scamming to maximize their own gain. They might have short-term wins, but they burn bridges, destroy trust, and ultimately, our sources argue, they go nowhere significant. You need to identify takers fast and cut them out of your professional and personal life.
Okay. Matchers.
They operate on reciprocity, tit for tat. You scratch my back, I'll scratch yours. It's a fair transactional approach. I did you this favor, so now you owe me one. It works. It's balanced, but it's calculating.
And givers?
Givers are different. They focus on contributing, on helping others, on adding value without keeping score. They try to ensure the other person gets the better end of the deal. They operate from a place of abundance, focused on helping the team, the customer, humanity.
And counterintuitively, they end up being the most successful.
That's the argument, because they build immense goodwill, trust, and strong relationships. The universe, or the market, or just human nature seems to conspire to help givers in the long run. Their positive impact comes back to them multiplied, often in unexpected ways.
Okay, let's bring this back to the core mechanics of building wealth over the long term, applying that patience and discipline. Fundamentally, investing success comes down to just 3 levers, right?
That's it. 3 key variables. 1, how much capital you start with the amount. 2, how long you let it grow the length of your runway, time. And 3, how well your investments perform the rate of return.
Starting capital, time, and return rate. And of those 3, which one is the most powerful, often the most overlooked?
Time, without a doubt. The length of the runway is where the real magic happens. And we can understand why using a simple but incredibly powerful mental model, the Rule of 72.
Ah, the Rule of 72. Explain how that works.
It's a quick mental shortcut to estimate how long it takes for an investment to double in value. You just take the number 72 and you divide it by your estimated annual rate of return, expressed as a percentage.
Okay, so if I expect my investments to return, say, 7% per year on average.
You divide 72 by 7. That gives you roughly 10.3. So it'll take about 10 years for your money to double at a 7% return.
And if I could get a 10% return?
72 divided by 10 is 7.2. Your money doubles in just over 7 years, a 12% return. 72 divided by 12 is 6 years to double. It gives you a tangible feel for the power of compounding.
And compounding isn't linear, is it? It starts slow.
Exactly. It's exponential. It creates that famous hockey stick curve. The growth feels almost boringly slow for the first few doubling periods, maybe the first decade or 2. But then, as the base gets bigger, the doublings become massive in absolute dollar terms. It accelerates dramatically.
There's a historical example that really drives this home, the purchase of Manhattan Island.
Yes, it's often used to illustrate other points, but the financial math is mind-blowing. The Dutch bought Manhattan from the Native Americans in, 1623? For goods worth about $23 at the time.
Seems like a ridiculously low price now.
Of course. But let's apply the Rule of 72. Imagine the Native Americans had somehow taken that $23, invested it, and achieved a pretty conservative long-term average return of 7% per year.
Okay, 7% return means doubling roughly every 10 years.
Right, and from 1623 to today, that's about 400 years. So how many 10-year doubling periods is that?
About 40 doublings.
Exactly. So what happens if you double $23 40 times?
It gets big. Really big.
It gets astronomical. $23 doubled 40 times works out to roughly $23 trillion.
Trillion. With a T.
With a T. For context, the entire current net worth of the United States is somewhere around $150 trillion. That initial $23, just through the power of time and consistent compounding at a reasonable rate, would have grown into a significant chunk of the entire nation's wealth today.
That's incredible. It really shows the power of a long runway.
And here's the kicker. What if they had started just 100 years earlier in 1523 with the same 7% return? How much would they have needed to start with to still end up with $23 trillion today?
Less than $23, obviously. How much less?
They would have only needed to start with about 2.3 cents.
Wow, so the starting amount becomes almost irrelevant if the time horizon is long enough.
Precisely. Time is the great equalizer, the most powerful engine in wealth creation, which leads directly to the core advice for beginners.
What are the absolute priorities if you're just starting out?
Priority number 1, based on Dhandho principles. Spend less than you earn. Master that discipline first. And critically, save the first dollar you earn. Don't wait to save what's left over at the end of the month. Pay yourself first.
Okay, save first. Priority 2.
Start young. As young as humanly possible, that money you invest when you're 18, 20, 22, that's the money that benefits from the longest compounding runway. It gets 40, 50, 60 years to grow. Money invested later simply cannot catch up due to the exponential nature of compounding.
So save early, start early. Priority 3.
Keep it simple. You don't need to be a stock-picking genius or chase complex strategies. For most people, the best approach is to invest consistently in a broad, low-cost market index fund, something that tracks the S&P 500, for example.
Or maybe a well-managed, disciplined vehicle like Berkshire Hathaway's B shares, BRKB was mentioned.
Right, something diversified, low-cost that you can understand and hold for the very long term. Set it, forget it, keep adding to it consistently. Don't tinker.
There was an example of an 18-year-old investing just $5,000.
Yeah, a single $5,000 investment made at age 18. If it earns a 10% average annual return, which means it doubles roughly every 7.2 years using the rule of 70
Of each 68, 50 years later.
that's almost exactly 7 doubling periods. 50 years, 7.2 years doubling. So $5,000 doubled 7 times becomes roughly $500,000.
From one single $5,000 investment just powered by time and compound growth. A 100x return.
It demonstrates the principle perfectly. Time does the heavy lifting. Which brings us to the final crucial warning.
What to avoid?
Avoid short-term speculation, especially day trading. Our sources are unanimous on this. Day trading is not investing, it's gambling.
And the house always wins.
Statistically, yes. The brokerages, the platforms like Robinhood, they make money on the transaction volume, the churn. The average day trader almost invariably loses money over time. Look at the Forbes 400 list, the wealthiest people in the world.
How many are day traders?
0. None. Wealth is built through long-term ownership of productive assets. Through patience and compounding, not frantic short-term trading. Stick to the marathon, avoid the sprint. Hashtag tag outro. So, wrapping this up, what we've really outlined today is a kind of blueprint. A low-risk pathway to building not just a business, but financial mastery. It starts with that core Dhandho logic.
Right. Structuring things so heads I win, tails I don't lose much. Finding ways to take risk off the table, like the Patel Motel owners did with labor costs. Structural arbitrage.
Then applying those key mental models. Using cloning strategically to get a massive head start. Not being afraid to copy and optimize proven concepts.
Focusing on purpose over profit to sustain motivation. And then executing relentlessly, finding those offering gaps. Using extreme listening like that slide 10 moment.
And building resilience through understanding the law of averages in sales and outreach. Taking enough swings.
And underpinning it all is that crucial financial discipline. Understanding that time, that long runway, is your single greatest asset in investing.
Harnessing the rule of 72, letting compounding work its nonlinear magic over decades. Even small amounts, saved consistently and started early, can grow into truly life-changing wealth.
So the challenge, back to you, the listener, is maybe to take a hard look at your own orange blocks, that unstructured free time. Is there a yellow block idea simmering?
A business concept, a skill you want to build. Is it genuinely more exciting to you than your current leisure activities? Because if it is,
the low-risk Dhandho path to actually doing something about it is clearer than you might think. You don't necessarily need a huge bankroll. You need creativity, discipline, and that willingness to start small and listen intently.
And maybe a final provocative thought to leave you with, inspired by IKEA. Ingmar Kamprad, the founder, apparently thought in 500-year timelines. Can you imagine?
500 years, wow.
And he built the company entirely without debt. But he also enforced a fascinating rule. No 2 IKEA stores could ever be identical.
Why? Seems inefficient.
It forced constant incremental innovation. Every new store had to find small ways to improve on the last one layout, logistics displays. It mandated continuous measurable improvement within strict financial constraints.
So the question for you is, how could you apply that kind of thinking, that long-term debt-free vision, combined with mandatory, continuous, low-risk innovation to your own work, your career, or that startup idea? What structural constraint could you impose on yourself right now to force creative optimization?